Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, Financial Enhancement Group, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. This is March 17th, so happy St. Patrick's Day as you receive this. We, of course, are recording this beforehand, and what happens between now and then is a Fed meeting, the first of what's going to be several. So not a whole lot to unpack on this week, but probably we'll be getting to next week. Hopefully we won't have any major surprises there. Market fully expects some activity in terms of a rate hike. So we will see this time next week. Moving into this week, we do have a week full of unpacking several different markets. We're going to hit basically all the major asset classes. We're going to talk about gold, the volatility we've been seeing in bonds, and our typical standard daily chart on the S&P 500, something Andrew covers in our weekly investment meeting each and every Monday. Take a look at oil, which is, of course, a very important central market to these days, both to as a symbol for what's happening in Europe, to potential economic impact and so forth. So we'll take a look at oil, and then lastly, inflation in the report that we got last week. So we'll dive right into it in gold. So gold, I think we explained a few weeks ago, we gave an uncharacteristically long leash, okay, for something like gold. It doesn't have a board of directors. It doesn't have a dividend, or it's a shiny metal that you hope somebody will pay more for than you bought it. So it's tough to give it a whole lot of a long leash. You don't have a strong fundamental characteristic, but we believed it had a strong place in the portfolio because of this market that that was coming to us. One that we expected could be challenged with higher interest rates. We can hit stocks and bonds at the same time, and of course, may not be good for gold either. But having a steady other asset class was important. So gold has played a major role, but last week Andrew spotted a good opportunity to take some profit. So this is a chart of the gold ETF that we own, and I'll let you, Andrew, point out basically what we've seen over the past several weeks.
Yeah, gold traditionally is always thought of as kind of an inflation hedged asset class. That really wasn't something we saw last year when inflation started picking up. After gold had kind of been an underperformer for a while, we started seeing inflation data start to rise. And inflation as gold, as you can kind of see on this chart in the end of 2021, really didn't see the big move higher that you would have expected. We still believe that gold has a good diversifying characteristics, and why we still think it fits in most different portfolios. But here, as we started kicking off 2022, with some risk appetite started to decline and equity started to struggle, gold started to accelerate up to the upside, and we saw this very almost near vertical move higher in gold prices. And we started seeing sentiment was getting very, very frothy when we were getting back over $40 on GLDM, which is a gold ETF. And so we decided to take back a little bit of the exposure there, decrease across several of our models, still owning a little bit of gold. As we said, we still want to have some longer term exposure there, but just taking a couple of dollars off the table as gold prices now, since we did sell, have begun to come down, as we're seeing kind of across the commodity complex. After the strong runs they've had, some of those gains are starting to get digested. And so we just want to be a little bit active in that and take some money when we can.
All right, now keeping things moving and moving over to the bond market, and specifically, we're just going to speak to the volatility. Of course, a lot of focus is on down pressure on the stock market. We've covered a few times and just how bearish the bond market has been relative to its own history. But along with that downward move, we've seen a lot more volatility. So what this chart is something we put together to measure the number of days in the last 60. So a rolling count of how many times we've seen the AGG, which is Barclays Aggregate. It's probably the most widely followed bond index, huge ETF. So the number of times that it moves 0.5%, call that 50 basis points in a single day. And if we want to start looking at this chart from the bottom on the way up, if you look at the bottom, you'll see a lot of the time this line stays really close to the bottom, which means we aren't counting very many days at all. In fact, a lot of the time, 0 days, meaning we're not accustomed to seeing the bond market have a lot of volatility or move even 0.5% in a given day. But what we've seen here is this tick move on up. We've seen well over 10 and counting, and we're going to way higher days in the past 60 where it has moved a full 0.5%. So seeing wide swings in the bond market, of course, we saw it move more in 2008. That was its own unique environment with bonds at the center of that universe for a while. And then, of course, during the COVID spike there, very briefly, we saw some extreme volatility. And we're making this big, strong run at that. And so that's really the worst of two worlds when you have both a downtrending and a lot of volatility. Those two often go hand in hand. And that's what we're seeing this year for bonds. So, Andrew, anything you want to add to that? I will let you. I know bonds aren't necessarily your favorite thing, but volatility is. But volatility is.
Yeah, looking at, we have different bond volatility gauges that look at the options market, and they also look very similar to this chart, where they're back near the highs from the COVID crash, as bonds definitely are experiencing an increase in volatility from not only the price movements, as Adam's chart here shows, but also in the underlying options activity as well.
Gotcha. It's something we've shared with you guys many times. So one of the statements I made last year was that just an observation from my seat, and having done this 20 years and paying special attention to that bond market, I had never seen a more toxic setup for bonds. And the only time that I've seen that mesh was this year coming into 2022. So really toxic environment. We do find periods where they get attractive. I think we're probably nearing one here in the near term. So we'll see if we get a chance to play that volatility to our advantage. Thankfully, we've had a few opportunities to do that, and hope we'll continue to do so. Moving to the S&P 500, we want to keep you up to date because this is one of the most important things that we've watched, and it's queued up a couple of our moves. So, Andrew, there's a lot going on this chart. Where can we, the novice here, where can I look at to see what's going on?
Yeah, so I think we'll kind of looking at the broad strokes of what's going on here. Like Adam said, there's a lot of lines that I throw on different charts, specifically this one. And I think the biggest takeaway here is the fact that a classic definition of a downtrend on any chart is the sign of lower highs and lower lows. And we can very much see that on the far end of this S&P chart, where we're seeing lower highs and we're continuing to see lower lows. Obviously, no market's going to move in a straight line, whether it's equities, bonds, commodities, anything that we can chart there that has supply and demand is going to have some gyration, some kind of whipsaw type effect. And we see that most recently where we're seeing some consolidation near the lower end of this down channel. But right now it's kind of a classic downtrending market. Hopefully we start seeing some improvement here, but the lower highs and lower lows are not encouraging. And we've definitely seen kind of a shift from the bulls being in charge, like they were for primarily all of last year, to now the bears are starting to be a little bit more in control of this market right now.
Gotcha. Excellent job as always unpacking that. And it's also a reminder of a daily chart. All right. And a daily chart just means that each and every day has a bar on this chart, which also means going forward, each and every day, there'll be a bar on this chart. So what that means to me is that that's the case right now. But the advantage of seeing this form over time is that at some point in time, we will see the bears pass the baton back to the bulls. We'd all love that to be tomorrow. It may be 3 years from now. We don't know. What you can know is that Andrew will be watching this and sharing this with us each and every week in the investment meeting, and we'll be there to catch that period of time when that happens. So oil, as we continue to run the gamut here, this was really interesting, Andrew. Back in the day, those that have watched these market carvers for a long number of years will remember the big boats and the way that we used to talk about them, which is really another one of the things you look at in the chart world. And this fell, I thought, was just fascinating given the size of the oil increase that we see the commercials being net accumulators. So once again, back to you to kind of cover what's happening here in these readings.
Yeah, so a lot of lines on this chart too, but it's really pretty simple. So on the top panel, we have just crude oil, the price of oil. This was as of last Friday, so it's come down. We're actually back under $100 as when we're recording this. But we can look at actually how different trader groups are positioned in oil. So we can look at producers or commercial traders, essentially the people that are actually involved in crude oil or use it within their products. Think ExxonMobil. Think plastic companies or any type of company that maybe is using crude oil in their business. And traditionally, they're net short oil. They're hedging out their exposure to oil prices because they already have that long exposure within their business. So it's very unusual for us to start seeing these producer trader groups become actually expose themselves to being long crude oil. And that's what they're doing right now. And what makes it even more unusual, and why Adam was saying that this is such a fascinating chart, is because traditionally they start buying dips. They buy when oil prices are really low. For instance, they were trying to get long when oil was going negative during that COVID crash in 2020. It's very unusual to start seeing commercial traders, seeing the producers actually increase their exposure when oil has been so strong in this strong uptrend, when it's getting over $100 a barrel. Traditionally, they would be selling that strength because, again, they already have the exposure within their own businesses of being exposed to oil prices. So the fact that the read through to us for this is the fact that if they're getting long now when oil is already over $100 a barrel, then we think that the kind of the smart money is what they often get tagged as, still is pretty bullish on oil and the energy market, thinking that maybe that we don't know the absolute level of crude is going to go from here, but it seems the way they're positioned is that oil prices could stay elevated for at least the intermediate long-term trend. Now, that doesn't necessarily mean we couldn't see some pullback as we have here recently with oil now back below $100. But the fact that they're buying more oil contracts in the options in the futures market suggests that maybe oil will stay elevated for a while longer. We'll see if they're right.
Yes, sir. Yeah. It's fascinating because if I turn here and if I look out my window, I see, several thousand acres of farmland. And I just liken that to both of those being full of soybeans and corn, and then the farmers on top of that buying futures to get more long. that would not be something that you typically see, and they would have to be very, very bullish to be taken on that sort of a position.
Right.
But on that oil, one of the impacts is it's feeding this inflation story. They just won't seem to go away. We had a long period of sustained government support that led to strong demand in the face of the same time we had a massive supply shock. So strong demand with less supply, generally speaking, across the board has led to this sustained long period of inflation. And we got another report here, and we just still continue to trend the wrong way. One of the reasons why is, of course, oil and other commodities like food as well. Both of those pushing that higher. Not a whole lot I particularly want to share today, other than the fact that we continue to go higher, and that core inflation, which is really the more important one in terms from a policy standpoint, is well over 6%. So even though we see oil higher, and at some point in time, you have all the reasons to believe that you would have cycles do what cycles do and bring it down at some point, that core still being above 6 is why we're very likely to see the Fed not have any choice but to follow through with these plans of several rate hikes. And the things would have to get pretty nasty on their own, I believe, to avoid that because of that fact. So, Andrew, if there's anything else, please feel free to chime in and add to that.
Yeah, the other things I would just add, like Adam said, the headline number came in at 8.7%. That year over year, the broad measure of inflation, the CPI, is up 8.7. Energy prices, as we've talked several weeks, up over the last 14 of the last 15 weeks. And then something we've also been talking a lot about is the rising commodity costs. And the fact that when we look at the food at home component, think grocery bills, things like that, actually it was up 8.5% year over year, which is the largest increase since 1981. We're continuing to see that pinch on the consumer from both trying to fill up their gas tank and trying to buy groceries is where they're really feeling that rise in inflation. Those both components are continuing to rise as commodity prices on the agricultural side and on the energy side continue to have a elevated impact on inflation data. And as Adam said, that's the main focus right now for the Fed. And while they're not probably thrilled to be raising interest rates when we have a down stock market, they have to try to address the inflation. And the kind of the tools they can use to do that is raising rates. And we'll likely see that happen this week.
Yep, absolutely. So it does sound like a lot of hawkish points and things not great for the risk-taking environment. And that's just the reality. We'll always give it to you straight, but also know that it's a blessing to have that information and to be proactively looking at it so that we can react on your behalf and make those changes to the portfolio. And we keep our eyes wide open because markets have a tendency, as we shared last week, to take off on their own. When the bad news is still out there looking bad, Anything can happen at any time. So we're here watching that for you. So once again, feel free to schedule a meeting, scan this QR code, or just give us a call, 800-928-4001. We'd be happy to have a meeting with you. And also don't forget about the radio show. Enjoy having you all focus in and listen to that. We get comments all the time about you happen to tune in Saturday mornings on WIBC or through your podcast, however you tend to get those. So thanks again. Happy St. Patrick's Day and have a great weekend.